So hello, Bob and Karthik. Thanks for taking the time to talk today. For this month's eLedger Explain topic, we're sort of taking a macroeconomic view of the e-liability methodology. Understand how emissions aggregate at different levels is also key to sort of developing eventually this global net zero strategy. So a key question we'd love to dive into today is how does the e-liability methodology aggregate up from transaction to entity to jurisdiction and eventually to the geological ledger?
Okay, well, thank you, Sandy. And in the first eLedger Explained, we went through how to take a firm's direct emissions and the emissions in its purchased products and services and assigned it to all of its output products. What we didn't say in that first video was, why do you do that? Why are a firm's outputs the natural unit of analysis? And there are several reasons for that. The first is that a firm sells multiple products to multiple customers. And if you're going to assign your direct and your purchased emissions, not all products are the same in their carbon intensity. And therefore, you really have to understand the heterogeneity of the demands on your purchased and produced emissions by the various products. And as we have learned, even for a firm which apparently makes only a single product, like tons of copper or tons of cement or megawatts of electricity, not all of those tons are the same. Even though physically they're the same, and therefore we refer to them as commodities, it depends a great deal on the inputs used to produce those outputs. And so not all kilograms of copper and cement or megawatts or kilowatts of electricity are the same. You really do have to look at the variation in the inputs used, and that could vary batch by batch, it could vary time by day, and to really have accurate accounting and tracing of emissions down a supply chain, it has to be done at the product level. And the only reason that a firm is emitting in the first place is to produce products and services that other people want to buy. You don't set up a firm just to say, okay, I'm going to sit here and produce emissions. Any firm is out there producing products and services, and therefore you have to assign and want to assign the emissions purchased and produced to the products and services they do. And as just mentioned, that because of the heterogeneity of first the output products, which use different amounts of the inputs, but also even if it's a common output, the heterogeneity of the inputs used in the production process. But let's also look at the converse. Suppose you didn't use products as your basic unit of analysis, and you use the firm as the basic unit of analysis. So now let's suppose you've accurately measured, here's all the emissions associated with firm ABC. Now it has lots of customers who want to know, well, what's my share of the emissions, company ABC, that you produced? And the only thing firm ABC can say is, well, you've purchased 4.63% of our output, therefore we're going to give you 4.63% of our emissions. Surprisingly, this is what firms are doing today. This is the problem that e-liability accounting was invented to solve, that you don't assign emissions based on some arbitrary basis like relative sales value. You assign them based on the actual content of the emissions in the products and services that you purchase. So the next question is, well, if you're doing it that way, how would you measure emissions at the firm level? So Karthik, maybe you could take over from this.
Sure, yeah, and let me just double click on the really important point that you made, Bob, which is that if you're trying to, we're creating an accounting system, a carbon accounting system, not for the fun of it, not to measure for the sake of measure, but because we want to give insights to managers into how to in fact decarbonize their operations. Now, when managers make decisions across, say, what inputs to purchase or what production process to use, et cetera, they need information.
What outputs to produce.
What outputs to produce. They need information at that level, right? Because that's the decision level. It's not firms that move through the economy, it's products that move through the economy. So if you're trying to create an information system that actually drives decarbonization, it needs to be decision relevant to the unit of decision making that is involved there. And that's why you have to start with the product. And so that's why you start with the product and then you work your way up from the product to the transaction. And then, of course, from there, you can aggregate up to the firm, which we'll talk about in a moment.
Yeah,
But Bob,
and just to triple click here, because a lot of the decisions of the emission intensity of a product or service occurs when it's designed. And so
yes,
the product engineers and the creative of the product or service have various choices they can make in which inputs they use to produce the output, and potentially even which type of suppliers to use. And so we need this information even in the original design of a product before it goes through or as it's going through a product development process.
that's right. Now, let's talk about the entity, right? Because, of course, what we want to do is to measure the embedded emissions in a product. And then as the product moves through the economy in transactions, we get the associated emissions associated with a given transaction. But then there's the entity level emissions. Now, crucially, when you're trying to calculate product level emissions, you do need an entity level ledger. And that's because there will be emissions that are incurred at the level of, say, a facility. There are emissions that are incurred at the level of the entity as a whole, right? So for instance, if you're running a large manufacturing facility, then the emissions will be facility-wide. If you have a CEO that travels around in a private jet, then the emissions are entity-wide. So you do need, in order to create product level emissions numbers or accounts, you do need an entity level ledger. And so the e-ledger system, the e-liability system, in fact, if you go back to our original November 2021 paper in the Harvard Business Review, we have there an entity level ledger. Now, why do we have an entity level ledger if the goal is to create a product level account? It's because that entity level ledger is where you park the emissions associated with, say, the facility, with the entity, and then you use the equivalent of cost allocation or cost accounting to drive down, but now not dollars and cents, but units of emissions to the individual products.
Yes.
Now, the beauty of the system is that it is reversible in the sense that once you have the product level emissions, then you can aggregate up all the product level emissions to the entity level ledger. But at the same time, in order to get the product level emissions, you need to have the entity level ledger. So that's the connection between the two. But sorry, Bob, go ahead.
So Karthik, there's one other reason for the entity level ledger, and that is timing differences.
That's
so
right.
I made a very simple statement of flow from inputs to process to outputs, but it can happen that not all the inputs you purchased in a period end up in products that are being transferred in the same period. And so another role for the entity ledger, in addition to capturing, say, non-factory level emissions, but general administrative type emissions, which eventually will also get assigned to the output products, but is to reflect the timing differences. And again, this is just basic inventory accounting to distinguish between raw materials purchases that have yet to be converted. There could be work in process. Product could be 2/3 produced when the end of a reporting period ends, and it could be finished goods, that completely, but we haven't yet sold and transferred them. And so the entity level ledgers are able to handle those timing differences.
Indeed. And of course, another source of the timing differences will come from capital emissions or emissions associated with capital equipment, right? So in the original November 2021 paper, we give the example of a car door. And we say in the supply chain of the car door, you're going to actually make the sheet steel, which eventually becomes the car door. So now if you look at, for instance, the steel foundry, it's got, say, the capital emissions associated with constructing that massive blast furnace. And there's, of course, that's incredibly emissions intensive to create that blast furnace because of all of the materials required for it. But then the emissions associated with that, with the construction of that blast furnace, are effectively depreciated over the useful life of that blast furnace, or all the steel that that furnace creates. And so effectively, you need the entity level ledger in order to create robust product level accounts. But it's through the creation of those robust product level accounts that you aggregate up and you get a full source or a full picture of the entity's emissions. So you have to start with the product, work your way up to the transaction, and work your way up from the transactions and the products up to the entity. But in order to start with the product, you need the entity e-ledger in the first place itself. So that's the first part of the chain right there. Sandy, back to you to see if we've addressed maybe the first elements of your question.
I think you guys hit all of the points so far, and then we can kind of move on to the jurisdiction and global level as well.
Right. So let me pick up on that, and Bob, jump in at the end of this description. So now you've got the emissions associated with a given entity, and you've got the emissions associated with the inventories as it's moving through a supply chain. Now, at the end of that value chain is the consumer that buys the product in which the emissions are embedded, right? That consumer can buy the product directly in a market transaction, or the government can buy the product and then allocate the product to the consumer through some sort of redistributive mechanism. So the parallels here now start looking very similar to GDP accounting, because in GDP accounting, it's the consumer that is the end of the chain. And the consumer can be, again, the direct consumer directly in a market purchase, or it can be the government. And so what is happening in the e-ledger value chain is that the emissions are moving from the books of one company to the next company to the next company, all the way until it makes it to the consumer. Now, the consumer themselves are not going to keep a ledger. I mean, most consumers don't even keep financial ledgers, so they're not going to keep e-ledgers. So what happens in the e-ledger system is the jurisdiction in which the consumer resides. So for instance, this could be the city, the state, or the country in which the consumer resides, is going to record, as they do for the purposes of GDP, what are all the consumption purchases and cycle purchases in a given period. And then the associated emissions from those units of inventory that have moved into the consumer's sort of hands are now represented on the jurisdictional e-ledger. So a core insight of the e-liability algorithm is that all emissions are measured. They are measured only once, and they are allocated to products. These are the only three things that need to happen: measure all emissions, measure them only once, and allocate them to products. So if you look at the whole value chain, the emissions associated with any particular activity in the economy is always only represented once in a net basis on the e-ledgers of all of the entities in that value chain. Because if I'm the entity that created the emissions, then, and I haven't sold the underlying unit of inventory, then it's sitting on my balance sheet. If I've processed that unit of inventory and sold it to my customer, then on a net basis, it's only sitting on that customer's balance sheet. And then if that customer has sold it eventually to the end consumer, then on a net basis, it's only sitting on the jurisdictional balance sheet. So the jurisdiction is basically playing in creating this environmental ledger, is basically playing this very important role of holding the consumption-related emissions. That is, the emissions that are held by the citizens or individual consumers in that economy. The jurisdiction can also consolidate the emissions held by all of the various companies in its in its area of operation, in its sphere of operation, because on a net basis, nothing is counted more than once. That's the beauty of the e-ledger. So all you need to do is to take the net ledgers of all entities in your jurisdiction plus the consumption-related emissions, and it will add up to the jurisdiction's total stock of emissions associated with its economic activities. And that is, again, very similar to how financial accounting and GDP accounting articulate in the financial sphere, that is in the monetary sphere. And that actually allows for some very powerful analysis and management of emissions at the jurisdictional level. Now, the same logic applies at the global level which we'll talk about in a moment. But there's some really powerful insights to having this kind of jurisdictional e-ledger accounting, which Bob will pick up in a moment. Bob.
I was really going to talk about a dysfunction in a simplistic version of jurisdictional ledgers. Prior to the innovation of e-liability and e-ledger accounting, the only thing that really could be measured were direct emissions, or so-called scope 1 emissions. And jurisdictions started to measure that at their jurisdictional level. And had nothing to do with supply chains. They were just looking at the direct emissions. And then, which is okay, but then the problem is they started to set targets to reduce their direct scope 1 emissions in their jurisdiction. And this has very perverse results. Just to take not a hypothetical, but actual real example, in one European country, in the Netherlands, they have a very thriving agricultural industry. And agriculture produces a lot of direct emissions. And so the Dutch, well-meaning, said, we're going to save the world by reducing our agricultural emissions in the Netherlands. And they did this not by making the farms more emissions efficient, but saying, we're going to start to take away your license to operate. We're going to consolidate and reduce the quantity of emissions by reducing, the quantity of output being produced on farms. This was not popular among the Dutch farmers, and in fact led in part to a change in the government, as the farmers joined a movement to protect properly their livelihood. But if you think about it a little bit, it doesn't make any sense to do what they were advocating, because the demand for food in the world is not decreasing. There's not an oversupply of food, and as the global South gets richer, they will consume more food. So the demand for the outputs of farms is only going to go up. And take the hypothetical. I mean, suppose the Netherlands government, was successful in reducing the quantity of output of farms in the Netherlands. That's not going to reduce agricultural emissions. Some other farms in other regions, perhaps, in the global South, who are not as carbon efficient as the Dutch farms, they will grow the food to substitute for the reduction in the supply from the carbon efficient farms. And so we have to look at these jurisdictional emissions, and their implications, thoughtfully. And what would be reasonable to do is not to hold potentially a jurisdictional accountable for their total scope 1 emissions, but for their emissions per unit of output produced. Let's get all the companies and farms and entities in our jurisdiction to be more efficient, not by shutting them down, but by getting more output per unit of more output per CO2 emission. And I think that's the right metric, is to try to reduce CO2 emissions per quantity or unit of GDP or whatever output you want to do. That's a good thing.
That's right. And in that example, what the Dutch were trying to do under the old system would be the equivalent of saying, oh, we've got a problem of too much inequality in our society, so let's solve this problem by making everyone poor. Because if we make everyone poor, then there's no inequality, and we've solved the problem of inequality. But that makes no sense, because people don't just want the absence of inequality, they want to have flourishing lives as well. So the whole point of looking at the measurement in concert with, say, GDP is to say, okay, well, we want to have a sense of what is the emissions associated with our economic activity. And then we want to say, okay, how do we use that measure of the emissions associated with our economic activity to sustain that economic activity in a way that's even more efficient? So that's why in our video on electricity emissions, we said the goal here is not to stop using energy. That would be absurd. We need energy to do all the things we want to do in order to flourish. We, in fact, want to build a goal of energy abundance. But you build a goal toward a goal of energy abundance by measuring what is the efficiency associated with the energy you produce. And if you are able to measure that energy efficiency, and you are able to therefore incentivize innovations that get you energy for lower units of input, in this case, lower units of emissions, then that gets you to the goal of energy abundance. And so that's why having sensible measures matters in the context of these sorts of big decisions to be made. But the other important implication of the Dutch example with the cows that Bob gave is that the only emissions at the only sort of net zero target that matters is the geological net zero. Right? Because if the Dutch say the way to solve this problem is to take the cows off my balance sheet and put it on the balance sheet of Spain, well, that's not solving any problem, because whether you're in the Netherlands or in Spain, you're still going to be breathing from the same atmosphere. So the only emissions that matter, and my colleague Miles Allen has made this point, the only net zero that matters is the geological net zero. And that's why one of the things that these jurisdictional e-ledgers that we talked about a few minutes ago, one of the things that these jurisdictional e-ledgers do is that they feed into the creation of a global e-ledger. So just like you can take the entity level emissions and in a jurisdiction, and then the consumption related emissions in a jurisdiction on a net basis, aggregate those and get to the jurisdictional amounts, you can take the jurisdictional amounts and aggregate those and get to the global amount. And that is your global e-ledger. And when you say, okay, in that global e-ledger, we have the full list of e-liabilities on a net basis, we can aggregate everything up because everything is counted only once, and that should add up to the 50 gigatons. That's the beauty of this system, that it material balances. It is unlike with the greenhouse gas protocol, where if you added up all of the scope 1, scope 2, scope 3 across all the companies, you would end up with some number that is geometrically larger than the amount of emissions in the atmosphere. It makes no sense at all. What the beauty of this system is that everything is counted only once. So once you add it all up on a net basis, you will get to the 50 gigatons on the liability side. And then you say, okay, well, what we want to do is to get that in a net basis to zero. So we want to, for instance, get to a level where, we have only a certain ppm of CO2 in the atmosphere, maybe based on, what the levels were in 1980 or what the levels were in 1900. That's a matter of public policy that certainly we're, as from an accounting perspective, entirely agnostic on. But we say, okay, if we want to manage to that, then let's look at the asset side of the ledger as well. And the asset side of the ledger is what's going to tell you what are your removal activities. And then at that geological scale, if you say, well, all of the assets are greater than all of the liabilities, or are at least equal to all of the liabilities, then you're net zero. And that is the only net zero that matters. Because if you have the goal, as say SBTI has, which again is a nonsense goal of saying all of these companies need to be net zero, then you're over-engineering the problem. And you're over-engineering the problem in a way that makes it cost prohibitive. You will never have companies all working towards making their operations net zero, because A, that's infeasible, and B, it is exceptionally more costly than is needed to solve the climate problem. Yeah. And so that's why this jurisdictional or global or geological e-ledger really matters. But Bob, go ahead.
Yeah, it certainly, if every entity in the world were net zero correctly, that would be sufficient. But what Karthik has just said, that's very expensive, and very importantly, it's not necessary. I mean, if the final entities in any supply chain are net zero, that's fine. And you could have all kinds of positive net zero, a positive net upstream. But you only need at the final stage, okay, after all is said and done, the captured and sequestered carbon equal the produced carbon. Now we're at the geological net zero.
That's right.
That does not require every entity or every jurisdiction to be net zero.
The only thing that matters is the Earth needs to be net zero. That's it. And this is why my advice to organizations like the SBTI would be, well, let's focus on creating and focusing our energies on producing a robust geological balance sheet, e-ledger. And if we can create a robust geological e-ledger, we can from that measure and track our progress to the geological net zero that matters. But then leave it effectively to the transactions where we started this conversation and the products even before the transactions, the entities and the jurisdictions to figure out how it is you manage to that geological net zero.
Okay, thank you so much both. This is incredibly insightful.